It's time for In the Money, Stock Market Action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everybody. Welcome to the show today. Happy Memorial Day weekend to each and every one of you out there. Hopefully you're all headed to the beach today or going to enjoy family time, remembering those that have fallen in past U.S. wars. Now, the key for today on this Sunday, May 25th, 2014, is to understand what the market is going to do in the coming days and weeks. And again, we have a market that continues to just chop sideways, continues to butt up against the all-time highs on the S&P 500, and that's what we saw on Friday. Friday, the markets closed at 1900.53 on the S&P 500, a new all-time closing high. Now, one thing just to keep in mind, the markets are not blasting higher. We're not seeing the market up 10% for the year in the first quarter in a couple months here. We're not seeing major aggressive buying out there. What we're seeing is minuscule volume and a market that comes down and then it pushes up, then comes down, then pushes up and just gets to an all-time high again before coming back in a little bit. And again, if you look at the charts over the past couple months, we've had a very choppy market. But the bottom line is the S&P 500 did close at a new all-time high above 1900. Now, I want to take this time to explain how the Federal Reserve works here. I want to talk to you guys about the manipulation in the charts, especially going into holiday weekends. I think this is one of the most fascinating things in the market that you can see. And again, it's something that it's very obvious when you understand it. So let's get into that right now. All right. Notice how going into a holiday weekend, the markets happen to float higher for 3 consecutive days. Starting on Wednesday, after a down day on Tuesday, the markets were up. They were up on Thursday. They were up on Friday. All right, so you might ask yourself, well, is this a coincidence? Is this just a random occurrence? No, it's not. If you look at past holidays, whether it's July 4th or Labor Days or Memorial Days or into Christmas, any of those holidays, generally the market will float higher into the holiday weekend. Why? Well, let's analyze that right off the bat, because this is something that if you understand it, you start to grasp the essence of the market. Number one, markets float up into holidays because there are less traders on Wall Street trading. What does that mean? Well, it means that, John Smith, who trades on Wall Street for a hedge fund, he's taken off early and going to enjoy the time off with his family. So he's taken off by Wednesday. He's done for the week. He's not going to mess around because the volume, again, is going to get lighter. He's made his $5 million for the year already. He's headed off and, again, going to enjoy time with his family. So when you take out Wall Street traders from the mix on Wall Street and in the markets, you essentially are detracting 50% of the volume, if not more, out of the market. 100% done. They're out. So who does that leave trading the markets and buying the markets or selling the markets? Well, it leaves the average investor. The average investor's out there just saying, listen, all right, what the heck, I'll buy 100 shares of Apple or I'll buy 100 shares of Microsoft. Let me just buy that and just, hold it. I'm feeling pretty good. Markets are still near their all-time highs. So that's what you have there. And that's the first step to understanding this market and why it floats up into a weekend or a holiday. I should make that clear. All right. So now why does a market, why doesn't the average investor sell into a holiday? Let's look at that because, in theory, if just the average investors are left in the market buying or selling, well, doesn't it mean that there's a 50-50 chance that the markets could float down into a holiday weekend? The answer is no. This is where you get into market psychology. And market psychology is the reasoning behind everything that the market does. All right, people, remember, mentally, you make a determination. If earnings come out, are they good or are they bad? How do you feel about the economy? Well, that's your psychology. What's your gut feeling? And that'll cause a reaction in buying and selling. So going into a holiday weekend when it's just the average investors buying or selling, notoriously, I would say 4 out of every 5 times the markets will be up. Why? Well, because inherently, the human emotion that's going to overpower things is going to be the positive, especially in a market condition like this where we're hovering near the highs. All right, now why? Well, remember, just as a human being, the majority of us look at a cup or a glass as half full. Just the way you do it. Now, there are others out there that look at a glass half empty. There are some, right? We all have friends that maybe are a little bit more down and they're kind of the depressed more type. Well, guess what? Our society medicates those people to make them positive with antidepressants. So generally, the general skew of everything And the human nature is going to be positive, half full. Okay, well, if a majority of average investors are looking at the market and they're not scared by any crazy things that are going on right now, they're going to be buying the market. Doesn't mean they're going to be buying a lot, but in general, you'll see it skew to that direction. And that gives you an understanding of why when Wall Street traders and institutional players exit the market for a holiday, the light volume takes over and the markets will generally float up. All right. Now, looking at the markets here, S&P closed at a new all-time closing high of 1900.53. Now, is that just a random occurrence that you closed above a key level like that? And the answer is no, it's not. The markets notoriously, you can go back in history and do a case study of this. Going into major holidays like Memorial Day, July 4th, and so forth, the markets will close at a key level if they're close to that key level or just above. Why? Well, let's look at it from the Federal Reserve standpoint. All right, so we all know the Federal Reserve has been stimulating this market for a long, long time, even more than 5 years, but it's been a majority in the last 5 years as they've printed $4 trillion and just tried to reinvigorate this economy over and over again, trying to pump it up, get people spending, get people more confident so they spend more. Well, what's one of the ways you can get people to spend? Well, close the market at a new all-time closing high above a key level. Well, why is 1900 so important? Well, think about it from the perspective of the Federal Reserve. All right, the Federal Reserve knows, and these are, any players that want to kind of perpetuate an up market and a recovery and force people out there to spend. Well, if the economy is doing all right and it's limping along, we all know it's limping along, but the market again closes above a key level, the media will take that as headline numbers. And I kid you not, literally minutes after the S&P closed above the 1900 level on Friday, we saw a headline on Yahoo Finance, on Market Watch, on all these outlying, financial news media outlets, and everything was S&P closes above 1900, new all-time high, and they pumped it up. They pumped it. All right, well, now look at it from the perspective of the Federal Reserve. The Federal Reserve wanted that to happen because it translates into the average investor reading that and saying, oh, my goodness, this is great. All right, now, why is it important into a holiday weekend? Well, think about all the buying and travel that's done on a holiday weekend. All right, do you think that people would be more likely, and we're talking about the average investor now, would they be more likely to go spend more money, maybe buy that extra TV on sale at Best Buy or wherever, or go and make that travel and stop along the way and spend a little bit more money on their trek if the market was down 300 points on a Friday before a holiday weekend, or if it closed at a new all-time high above a key level where the media pumped it like crazy? Well, obviously, they would look at it and say, well, listen, things are looking a lot better. The media is pumping it to these average people. They're going to be out there spending more. That is your reasoning behind that. All right, so make sure you understand that. It's not necessarily always a coincidence that going into a major holiday 3-day weekend where there's lots of Memorial Day sales, lots of July 4th blowout sales, the market happens to close above these key levels for a reason. And I personally, listen, do you think the market would have still closed right at, let's say, 1899 or 1898 going into a holiday weekend? Yeah, it could have, just without the Federal Reserve. But in my opinion, there's a concerted effort there to get the market above a key level because they know the media will pump it harder and it will make people kind of have a positive reaction. And remember, the Federal Reserve wants the average consumer out there spending their money because it will stimulate the economy. And what better way to do it than going into a big Memorial Day weekend feeling jovial and, oh, this is great. Markets are at all-time highs. My 401k is doing awesome. And it just got a new closing high above 1900. I'm going to go out and buy those extra few things. I'm going to go spend. I'm going to go to another restaurant this weekend and spend a little extra money because this is great. And again, look at the other side of the coin. If the markets were down 300 over the last couple days, do you think that, listen, people would still spend money, but do you think it would be as much? And it's all about consumer spending. If you look at what's driven this economy over the last, 20 years, plus even more than that, it's consumer spending. We are a consumer-driven economy. And again, why do you think the housing collapse was such a big issue? Well, because people had put so much money into their homes and they were expecting their homes to multiply in value for so long that they were spending lots of money in 2007, 2006. It was a great time. Well, guess what? When their home collapsed in value by 30, 40, 50%, guess what happened? The purse strings closed up. Consumers stopped spending. The economy had a major collapse. So ultimately, if you're looking at the Fed wants to create this recovery. The Fed has said, and this is Bernanke's thesis from back when he was a professor and he did his thesis, or before he was a professor, and his thesis was that if you create the sense of a recovery, make people believe there's a recovery, then they will create the actual recovery. And you can go do research on this, folks. Go out there and look at his thesis. All right? You will see that this is his plan. This was his big idea. And he has tried over the last, well, I mean, he's not the Fed president anymore, the Fed chair, but ultimately that was his idea behind all this stimulus. Drive the markets higher. Even if you're creating a new bubble, who cares? Pump enough money in, get interest rates lower, push the stock market higher, make people believe there's a recovery, and the recovery will follow. Now, I personally don't subscribe to that mentality. I think, and again, I think the proof's in the pudding now as we see an economy that's growing at 0.1%. Granted, you want to discount it a little bit because of the bad weather in the first quarter. Fine. Let's call it 0.5%. Let's call it 1%. I don't care. The point is that's not robust growth. And again, what types of jobs are being created? Low-paying jobs. That's not going to help people overall. So in my opinion, it's been a failed policy, but it is what it is, and we got to abide by it at this point. So that's where we stand. All right, in any case, going back to the markets again, markets closed green for the third day. One thing I want to mention, NASDAQ closed up 31 points or 0.75% on Friday, while the Dow and the S&P were only up about 0.4. One thing that changed last week, we started to see the NASDAQ take leadership, which again, I think will continue. Remember, NASDAQ stocks have been hammered insanely. So those stocks are now bouncing back. I think that will peter out in the coming week. We're going to get into that in a little bit. But before we do, I want to take a break. I want to catch my breath here. I want to make sure everyone out there is having a wonderful Memorial Day weekend. And again, we're going to take a break here. My name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. And this is In the Money Stock Market Action on 820 AM News Talk Radio.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
Welcome back, everybody. Again, a happy Memorial Day weekend to each and every one of you out there. Today's Sunday, May 25th, 2014. So let's get back into a couple of the things that I thought were really interesting. And I'm bringing to you today some really kind of shady aspects of Wall Street because I think it's a little slower out there in the market overall. We'll still go over market action and what's going to happen in the coming week. But I want you guys to really understand the inside kind of track of what's been going on Wall Street. And the next thing I wanted to talk about today was oil. Okay? Let's talk a little bit about oil and the price of oil continuing to rise into a holiday weekend. So if you look at the chart of the USO, which is the oil ETF, or if you look at oil itself, oil has continued to rally higher. All right now, pushing the recent 3 or 4 month highs, to be honest. Actually, it looks like, if I'm correct, we haven't been to these highs on oil since October of 2013. So we're talking about well over 6 months highs right now on oil. Now, you might say to me, okay, so what's the big deal? Markets are pushing oil higher, supply, demand, global economy getting better. And I would say to you, well, the global economy is not getting better. Look at China. China's bubble continues to be borderline collapse. They're doing everything they can over there, including making some very aggressive movements towards other countries in the region to kind of kickstart their economy in whatever way they can. If you look at Europe, Europe's still dead in the water. The U.S. is growing, 0.1%. As we said last segment, we'll give it 1%. But considering the massive amounts of natural gas being pulled out of the U.S. now, I mean, there's no reason to see oil up here or little, let alone even natural gas, in my opinion. So why especially over the last couple weeks has oil rallied higher and almost nonstop? I would say if you look at the last 2 to 3 weeks, oil has just headed straight higher almost every day. The only days it kind of didn't go higher, it was just going flat, consolidating before moving higher again. And the answer is very simple here. What do we know about holiday weekends? What are people doing on holiday weekends? They're flying places. They're driving places. They're out there traveling. So is it a normal occurrence? If you look back, right, and you look at July 4th period, let's say 2 or 3 weeks before July 4th, 2 or 3 weeks before Memorial Day, especially in the summer when people are out there driving a lot more, do you think it's a coincidence that oil moves up into those holidays? The answer is no. Well, what's going on here? Let's look at it a little closer. So you have oil companies and refiners, right? Now, the refiners claim that, they're switching over here. They have these mandates and, they got to make it cleaner fuel over the course of summer months and, all this nonsense. But they know that ahead of time. Do you think they're upset that the price of oil is going up a little bit? No. Do you think they're doing their best to pump out a little extra to keep prices down? Nope. So I think just all of us need to understand that, you're not going to hear this on CNBC, you're not going to hear this on Bloomberg, but this is reality. These companies they know they're going to make a little extra money. And again, I'm not out there trying to change it. I think it's something that each consumer needs to understand, that this goes on. Okay? I mean, just think about it. They know during these periods people are going to be driving more. If they wanted to, they could rally the team and get more production out there to keep prices stable. But they don't want to do that. It's not in their best interest. They know people are going to drive regardless of gasoline being, $3.50 versus $4. It's not going to really, that extra $10 out of each individual's pocket probably doesn't make them not go to grandma's house for the weekend. It's Memorial Day. You want to get out. You want to be out there on the beach with your family. You want to be having fun. That extra $10 isn't going to make a huge difference to you individually. And when you map that across the whole entire U.S., think about that extra money coming in. It's a lot of money. So, listen, Wall Street being Wall Street, I guess, if you want to make that as an excuse. I don't think there's an excuse out there, but, that's what it is. All right. Just wanted to cover that, too, because I did think it was an interesting point. Going into a couple other little tidbits here, I think the next thing that I want to talk about is the earnings this past week from Tiffany's. All right, we all know Tiffany's, right? Symbol TIF. They make lots of jewelry and really pretty stuff and shiny stuff and glamorous stuff. And generally, do they cater to customers that shop at Walmart? And listen, by the way, I shop at Walmart sometimes, I'll be honest. Or do they cater more to people that shop at really high-end boutiques and high-end stores? Well, Tiffany's obviously caters to those that shop at the high-end stores. It's just the nature of the beast. Their jewelry is higher priced. Now, they reported last week very solid numbers, very solid earnings numbers. And I thought it was very interesting because most of the retailers prior to Tiffany's, I mean, you could go to Aeropostale, which posted earnings Thursday into Friday, which I think the stock was down 30%. It's down from like $16 to $3. I mean, just horrendous. You could look at Walmart's earnings. You could look at Target's earnings. You could look at a bunch of these other stores, these retailers that are kind of catering to the middle class or just below, and their earnings were atrocious. So what is this telling us? I mean, let's analyze this and really understand what this is telling us. And I think what it's telling us is that what we've heard about the shrinking middle class and the growing rich and the declining middle class, and basically you now have two diverging groups. You have the rich and you have the poor. And listen, the middle class is still there to some extent, but we've all heard it shrinking. And I think Tiffany's is showing us that that's true. Because the high end, they're doing great. They're getting a little bit bigger, not much bigger, but they're getting a little bit bigger, and it becomes kind of the huge amount of wealth right there. And then everyone else is crowded into the lower realm. And the lower realms can't even go to Walmart and spend that much money. They're not at, Aeropostale spending that extra couple bucks on their stuff, or Target. They're holding back because they can't spend that extra money. But here Tiffany's is doing fantastic. Just absolutely wonderfully. And again, I think it just takes common sense to see that. All you have to do is look at Tiffany's and their earnings performance and look at what Walmart did, what some of these other companies did who cater to that middle class and lower, and they're not doing very well. So keep that in mind, folks. And again, a lot of people probably just didn't put two and two together there, but that's something that I found fascinating about those earnings. And it does tell us about the divergence. And it speaks to the larger group of what's going on in the economy, right? I mean, you have a lack of jobs, or they're lower paying jobs. They're not high paying jobs being created. So therefore, a majority of people are getting these lower paying jobs. I mean, remember, the Obama administration and the jobs people and everything, they're coming out, we're creating, 200,000 new jobs every month now. We're basically back to pre-2007 levels before things started to collapse. But the problem is these jobs they're not the high paying jobs they were back then. And there you can see it, because you have on one spectrum, Tiffany's doing great. Well, the high end is doing great out there. If you're in the high end, you're doing great. And then you have everyone else. And that is the issue there. And that's something we have to recognize. So going forward, I don't know how to do it, but with any luck, we can start creating some better paying jobs out there. Do whatever you got to do. Learn, adjust, adapt. Start becoming someone who can get that job. I mean, I wish I knew. I wish I knew. I wish I could be the one creating tons of new jobs, and maybe down the line I can. You know, we create some jobs here at In the Money Stocks, but unfortunately we're not a mega-sized player out there, not a Goldman Sachs or anything. But that's the ultimate goal, and I'd love to be part of that. All right. Going on to the next discussion point I wanted to have here. I want to talk a little bit about what the markets are going to do in the coming week. Okay? Number one, Tuesday, markets open. Remember, markets are closed on Monday. So Tuesday, the markets reopen, assuming there's no major geopolitical upheaval. And this is a big assumption, but assuming there isn't, markets should be very light in trading volume. It's what we call a hangover day. Just think about it in terms of what a hangover is, right? You partied too hard, the next day you're going to be moving a little bit slower. The markets react to that. That's the way they are. All right, remember, they play off of human beings, right? Humans are trading. If humans are a little slower that first day back, aren't we all a little more tired? You've been with family all weekend, or you've been out partying all weekend. You come back, that first day works a little slower. Well, guess what? The markets usually perpetuate that, assuming no geopolitical upheaval. So expect Tuesday neutral volume, very light. Volume should perpetuate neutral to upside price action. I think once you get into Wednesday, volume starts to return slowly, and you start to get some volatility, and you start to see some downside. And again, the reason I'm going off of that is because the markets of late have been very choppy, right? So in theory, every time we pop up to these highs and we make a new all-time high, the markets then see a sell-off of 1, 2, 3%. So I'm just going there and saying, listen, as volume returns, we should start seeing the pullback again. And then I'm continuing to think choppy, maybe a little downside if we get any major upheaval globally, which I think is very possible considering what moves China's making right now, and Japan, and I mean, you got Vietnam. I mean, there's a lot of stuff going on there. But bottom line, folks, be ready for a little action once Wednesday comes back, and look for some downside action. All right, my name, Chief Market Strategist Gareth Soloway at InTheMoneyStocks.com. Come visit us there at InTheMoneyStocks.com. This is In the Money Stock Market Action on 820 AM News Talk Radio. I'll be right back.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
All right, everybody, welcome back again on this glorious, warm Sunday, May 25th, 2014. Happy Memorial Day again to each and every one of you out there. Hopefully we are all able to enjoy a little bit of this wonderful weather, get to the beach, enjoy. All right, what I want to do now in this next half of the show, we're going to take a look at some of the key past interviews that I've done. Before I do that, I want to talk about one stock that I'm liking quite a bit. I do have a position in it myself, and the stock is Twitter. Now, you guys know I've been a huge short on Twitter, telling you guys it was going down, basically from the $70 range all the way down. But believe it or not, right now, it actually looks pretty good. And what I like about it is that the pattern is bullish. So you have a bullish consolidation movement on the daily chart, and it has a very defined stop. And why is it important to define a stop? Well, basically, if you have a stop that's close, it saves you. It essentially protects you. So if you have that situation where a stock is going to go against you, and listen, every once in a while we all take losses. All right, some more than others. If you know what you're doing, generally you take less losses and you're able to produce more gains. But listen, we're all going to take a loss at some point on a stock. So what you need to do is you always have to go into every trade you take knowing your downside risk. And the downside risk on Twitter, which closed around 30.5 on Friday, is a close with confirmation below 29.5. Now, confirmation is a proprietary indicator. We can teach you it in themoneystocks.com. If you're a member and you're listening, you know what I'm talking about. All right, but in any case, what I love about this is basically $1 lower with confirmation, and you move out of it for a small loss. If this works out to the upside and we start to see a gain over the next week or two, it has potential to go all the way to $40. All right, there's a gap fill right around $40 that looks very intriguing to me. And again, we'll know this week because it's either, I mean, you know the stock moves 50 cents to $1 every day. So basically it's either going to go one way or the other, and it's going to break down and fail the pattern, or it's going to start to play out. And right now it's in a tight consolidation channel. And we just continue to watch that pattern, which is bullish again. So I am long Twitter, and I wanted to pass that along to you guys over the weekend here looking into next week. All right. Next up, what I want to do, folks, is I want to listen in, as I said, to a couple of the old interviews that we did over the last few months. And I think these are fantastic interviews that are unbelievable because of who these people are. And I'm talking about Jim Rogers, Martin Armstrong, Patrick Byrne. Right, these are all people that I had on this show in the Money Stock Market Action. We interviewed, and they all, what I thought was amazing about these interviews, they all had very negative views on the Federal Reserve. And these are the experts in the realm. I mean, these are people who have traded and made, some of them, billions of dollars, literally billions in profits about the market and with the market and trading their hedge funds. All right, for instance, Patrick Byrne, CEO of Overstock.com. Jim Rogers, he used to run a huge, mega-sized hedge fund with George Soros. And these guys, you know, if I tell you what I think about the Federal Reserve, which is nothing positive, right? These guys, I consider them even better experts than myself. And if they have that same view, it makes me think you should start paying attention. And again, it doesn't mean the market's going to collapse tomorrow. It doesn't mean it's going to collapse next week. What I'm saying is you have to understand that year after year, the Fed has bailed this market out and the economy out by printing money, by lowering interest rates, and all it's done is perpetuate the next bubble, which if you're on the upside of that, that's great, but you have to know you need to get out at a certain point, and then it collapses back down. Think about getting out in 2007 before the collapse. Think about getting out in 2000 before the collapse. If you can time it, which is what you should be able to do, you can make millions, billions, whatever. If you can't, and you just think, oh, it's all going to be good because the Fed's here to save us, wrong. All right, let's listen into Jim Rogers here, guys. Great interview, and again, I'll step back on, but let's hear what he has to say.
We've seen the stock market since the lows in 2007 up 150%, just last year up 30%. I mean, as an average investor listening out there, are you thinking that there's more upside? Are we getting near another big collapse? I mean, do you have any views on that?
Well, I'm a little bit skeptical about the U.S. stock market, mainly because of most stock markets. Mainly because, you know, what's happening is for the first time in recorded history, we have all major central banks around the world printing huge amounts of money. The Japanese said they would print unlimited amounts of money. That's their word. The Europeans said we will do whatever it takes. That's the quote. So America jumped in, started spending $1 trillion a year, pumping money into the economy. The English jumped in. So this would never happen. So we're all living in an artificial ocean of liquidity, which has been rising pretty dramatically for several years. In my view, well, I know it's artificial. In my view, it's a terrible mistake because when this ocean dries up, we're all going to suffer and suffer badly. Now, the bureaucrats in Washington say differently, and bureaucrats everywhere say differently, but, you know, that's why they work for the government. Yeah, they couldn't get a real job. So they sit down there and they talk to each other with these strange theories. They're going to make us all suffer in the end. Now, the people who are getting the money now are having a wonderful, wonderful time. But it cannot last, and eventually we're all going to suffer.
Yeah, and I think it's kind of interesting to note also, you know, how the stock market has had a great run, but the major beneficiaries of that are the wealthier individuals who have a lot of investment in the market. You know, if you're on the poorer side, it's a lot harder to make money over the market's rise. So kind of interesting just to note that. And, you know, it's we talk about this divergence in the middle class shrinking and the poor and the wealthy gap rising. And it's got to be a major player there with the stock market up so much. It's helping one end of the spectrum and not everyone.
Oh, you're right. As I said, the people who are getting the money, whether it's in the stock market or elsewhere, banks, financial institutions, are having a wonderful time. But the fundamentals have not gotten better. As you know, unemployment is higher now than it was in 2008, and that's around the world. Debt on higher and higher and higher. It's inconceivable to me that the way to solve a problem of too much debt is more debt. But that's what they say. I mean, that's what grown-ups in Washington say. It's staggering to me that people could say that with a straight face. All we got to do is build up more debt, borrow more money, and spend more money, and everything will be okay. But that's the approach, and in my view, it's not going to work.
Yeah, absolutely. Now, your take on the Federal Reserve. I mean, to me, the Federal Reserve, if you go back to Greenspan, it just continues to build these bubbles, and ultimately we all pay the price for them, just like you were mentioning. I mean, are you looking at Greenspan and the Fed as having caused the financial collapse initially in 2007 and the real estate bubble?
That's what happened. I mean, anybody who says it's not what happened is go back to some homework. You read all the things that Mr. Greenspan and the Federal Reserve was saying. And Mr. Greenspan was saying everybody should go out and take a floating rate mortgage. Everybody should buy their own home, et cetera, et cetera. I have nothing against owning your own home, but I certainly have something against, buying 3 or 4 houses with no down payment and no job, which a lot of people were doing. It was madness. It is madness. Federal Reserve won't say that they caused it. But if you go back and read their minutes, I mean, at one point there was a major paper done at the Federal Reserve by the chief economist who started off by saying, there are people out there who say that housing is a problem and that we're all going to suffer. But how can they say that? We have 1,000 of the best economists, PhD economists in the whole world working here, and we know there's not going to be a problem. And they put this in writing. They really believed that they knew what they were doing, and they kept pumping money into the system, into housing. They weren't regulating. In theory, the Federal Reserve is supposed to regulate the banking system in the United States. Well, that's where the problems erupted. Problems erupted in banking, insurance, and Fannie Mae and Freddie Mac. And those are 3 of the most regulated industries in the United States. And yet the Federal Reserve, who was responsible, directly or indirectly for those industries, said there's no problem and kept pumping money into those industries. I don't know how anybody can, I guess people can say anything they want, but the problem came from Greenspan and the Federal Reserve. There are those of us who wrote it down and said it at the time that this was going to be a disaster. And, of course, when it did become a disaster, they all said they got lucky. They didn't know what they were talking about. Nobody could foresee it. This came from the central banks, just like the next problem is going to come from the central banks, and it's going to be a big, big mess, Gary. You should be worried, you should be prepared, and you should be looking around.
So now, speaking of that, where would you suggest the average investor kind of looks? Like, if you've got a 401k or if you've got an investment account, where would be that area that you would suggest kind of taking a look at for a good investment when things go south?
Well, first of all, people should learn how to sell short, which is a way to make money if things do decline. That's not for everybody. If you don't want to do it, then please don't. That's like, don't listen to me. But say, look in the areas you know a lot about. I, for instance, mentioned earlier, I'm not too keen on stocks in the U.S. because the U.S. stock market is near its all-time high. I'd rather look around the world at stock markets that aren't at all-time highs. There are markets that are low. There's things happening in China where the market's down 70%. There's good and bad things happening in China. In Japan, there are good and bad things happening. The market's down 60 or 70% from its all-time high. So there are places to look. In my view, agriculture is very depressed, extremely depressed. So I'm looking for investments in agriculture where I might see things getting better. But I don't like to jump on a moving train, and U.S. stocks are, as I say, at all-time highs because of all this artificial money printing, and I'm worried about how it's going to end. I'm not so sure it's going to end badly this week by any stretch. Don't think I'm sitting here saying, oh, my God, look out the window and jump out the window. No, I'm not saying that at all. But I do know that when this ends, it's going to be a problem for all of us. But when the next economic slowdown comes, and it will come, it's going to be a huge disaster because you've had all this debt which is built up. 2007 and 8 was much worse than the setback in 2001 and 2, which the debt was so much higher. My goodness, Gareth, this time the debt is multiple times higher. I don't see how we can get out without a big problem. We've had economic problems every 4 to 6 years since the beginning of time. I don't see anything that's going to stop that. We all haven't suddenly learned some kind of genius. People in Washington certainly don't know what they're doing, in my view. So we're going to have a new problem someday, and when that new problem comes, it's got to be worse because the debt is so much higher. I mean, it's staggering how much debt they've incurred. The Federal Reserve alone has quadrupled its balance sheet in just 5 years. I mean, these numbers are staggering. And yet in Washington, they say, don't worry, trust us.
Yeah, exactly. No, I'm in your camp 100%. Over the last month or so, I've been encouraging our listeners to kind of move into cash and take profits on this market, because I agree with you. It's just the writing's on the wall, and it's just a matter of time. I saw a panel with Ron Paul and you discussing how the Federal Reserve should be abolished. Do you think when everything goes south, there might actually be finally a push for abolishing the Federal Reserve?
Well, I do know that throughout history in America, we've had 3 central banks. The first 2 disappeared for whatever reasons. In my view, this one's going to disappear. Mainly, the world has problems without a central bank. There's no question about that. We all have problems without a central bank. But we also have many times problems with central banks. And this central bank is making our situation much worse. As I said, they have quadrupled their own balance sheet. Their debt has gone up by 400% in just 5 or 6 years. They're printing staggering amounts of money. This central bank is going to make things worse for all of us in the end. Now, whether it leads to the disappearance of the central bank this time, I don't know. In my view, it will, because they've made such horrible, horrible mistakes. And the public or the Congress or somebody will throw them out, or they'll go bankrupt. I mean, their balance sheet is a nightmare. It's worse than Fannie Mae and Freddie Mac was once upon a time. Now, by the way, if I say they go bankrupt, they'll obviously be bailed out by the government, which is going to make us all worse off. But the government may close it down at that point. So, no, in my view, we will be better off without this central bank. In my view, it's going to disappear. It's going to self-destruct. And when it does, we'll all be better off. But the only reason it's going to self-destruct, Garrett, and be sure you understand, is because of the problems which they are bringing to all of us, which are going to destroy themselves and harm us a great deal.
All right, guys, I'm going to step in here as we just heard from the legendary investor, Jim Rogers. And again, that's from a conversation I had with him just a month or so ago, and just a great one at that. Next, I want to take a little bit of a listen here to an interview I did with Martin Armstrong. Let's hear what his views are, because, again, my point is here to drive through to you guys that these are the experts out there. These are the true experts, not the ones that are hiding behind the media and all this nonsense and just hoping that they can make a little bit more money off the average investor. These guys have made their money. They understand the system, and they want the average investor to understand the system. So let's listen into Martin Armstrong's interview right here.
I think we're going to see another very serious crash, and more or less like the 2007 thing. Mm-hmm. But this time it's going to be probably a bit worse. It's going to be more focused in, I would say, pension funds, etc. The banks are not going to be bailed out like they were before. They're really persona non grata right now, and this is part of the reason why Obama was up there offering new types of bonds.
The Myra.
Yeah, and this is the way the banks have had this control. It's not some really, giant conspiracy of controlling the world. Basically, they have been manipulating markets. They lose money every time. They're not good at this, but they don't look at risk. They just figure that they always have the government in their back pocket to bail them out. So it's kind of like going to a casino and you put down $1,000 on red, and if you lose, you say, well, give it back to me and let's go again until I win. And that's pretty much what they do.
Martin, what happened to the toxic debt that the banks are holding? Is it still there? Has it disappeared into thin air?
And that's been largely what the Fed has been buying. So
that's what we assumed.
Yeah, it's that's pretty much what they've been doing, and some of it has now come back, and will come back because the dollar is going to still be very strong and probably the only currency to put money into. At this point, most people are not talking about the BRICS anymore. They're all going down. Mm-hmm. So, this is the same thing that happened in the 30s. I mean, Europe blew itself apart, so you have to put money someplace. And the U.S. was the only game in town.
Will Japan be the first to fall?
I think Europe and then Japan It's kind of going to be like that Greece thing, where once one goes, then they're going to look around and say, "Oh, they're next," and then it will become very rapid.
Okay.
So I don't see a lot of time delay. The U.S. will be the last, but it will happen, and that's largely what Roosevelt's confiscation of gold was all about, was that the dollar was so high that his recommendations was he had to devalue the dollar because we couldn't sell anything. And that's why he confiscated gold to prevent people from making profits from it, from the dollar devaluation that he did. So he took gold from $20 to $35, which is a fairly aggressive devaluation.
Yeah.
All right, just listening to Martin Armstrong's comments there on the Federal Reserve and everything. That was my business partner at InTheMoneyStocks.com interviewing him, Chief Market Strategist Nicholas Santiago. All right, what we're going to do here, folks, is take a quick little break, and then we're going to come back and listen into Patrick Byrne, CEO of Overstock.com, on his views. But again, this is In the Money Stock Market Action on 820 AM News Talk Radio.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
Welcome back, everybody. As we inch towards the end of the show today, I want to listen into a interview I did not too long ago with CEO of Overstock.com, Patrick Byrne. And again, before we get into it, just briefly, remember, this coming week, Tuesday, expect light volume, assuming no geopolitical upheaval, and then ultimately look for volatility to increase with some potential downside later in the week. All right, let's get right into it. Patrick Byrne here, interview of CEOs, the CEO of Overstock.com.
Something I've talked about to our listeners quite often is, the Federal Reserve and them printing this, endless supply of money, $4 trillion in the last 5 years or so. Are you a fan of the Fed? I mean, do you think what the Fed has done has been beneficial? Has it helped the average American or hurt? I mean, what are your thoughts on the Federal Reserve?
Well, it is definitely not beneficial to the country. We absolutely should dismantle it. Milton Friedman was once asked in 1992 in an interview with the Minneapolis branch of the Federal Reserve, in their publication, did an interview with him where they said, what's the most important issue facing America? And it's the most important issue facing America is how do we get rid of you, the Federal Reserve? And you need a lender of last resort. If you're going to have fractional reserve banking, I think you need a lender of last resort, which was the original mandate of the Federal Reserve. But it greatly expanded that into thinking it could micromanage the economy, and I think that's nuts. I lived in communist China back when it was still communist. I lived there in the early 80s. I'm very familiar with the Soviet era. And they end up running their societies with a great big set of bureaucrats in a place called, in Soviet case, Gosplan or something. That the Soviet Union, they were setting 23 million prices by hand. So there wasn't a market system. You had apparatchiks setting prices for every good, 23 million goods in society, right down to the screws that went into the casters under the shopping cart or something. And that's a silly, it's laughable. How would you try to run a society by setting 23 million prices like that? But in our society, the most important price we face is the price at which we discount the future against the present, which is to say interest rates. And what we have is a central planning agency setting those, and that central planning agency is a central bank called the Federal Reserve. It's a horrible institutional design. We shouldn't do it.
Oh, wow. Yeah, no, I couldn't agree more. I think it ultimately I actually think down the line it could be the undoing of the financial system based on everything that they're doing now. But, maybe they have a plan for that. I don't know, But
they have a plan. The plan's silly.
Yeah.
They have a plan. Their plan is silly. They're dreaming. You know what they're like? You know how there are Wall Street traders? I see that you're very familiar with Wall Street. You know how there's Wall Street traders that have basically blown up different firms by they do something like they sell long-dated out-of-the-money puts, and then they book it as income. And that may be a little technical sounding. I'm sure you know what I mean. But they can take a bet that pays off 9 days out of 10 or 9 years out of 10. And 9 years out of 10, you make $1 million, but then in the 10th year, you lose $100 million. Buffett calls it a business of picking up dimes in front of a steamroller. Well, that's really what the Federal Reserve is doing. They're doing this stuff that, they're not just the QE, but Operation Twist that they've done and the taking in the average duration of outstanding Treasury instruments has come way down in this administration. What they're doing is they're in a sense doing something that creates some good results today, but it's building up a bigger and bigger chance of an event, of a bad event, and that event is going to wipe out all the dimes that they picked up along the way. Someday they're going to hit by the steamroller. I can't believe, I mean, they know this. It's a very reckless strategy. It's an abominably reckless strategy.
Yeah, it seems to me like, they're creating every bubble and then they're trying to bail themselves out by doing this, and then it just creates another bigger bubble down the line that is going to be more catastrophic. And the poor average American's getting kind of caught in the middle of it.
Yeah, I knew a crackhead who had the same strategy. That's basically their strategy. I'm going to smoke some crack and get high, and then when I come down, I'll just got to smoke some more, and you got to smoke more and more and more and more. Well, what kind of, that's our monetary strategy. I don't even think they have a strategy. I think they've driven down a cul-de-sac. I think there's one guy, Peter Schiff, who says they've driven into the monetary roach motel. There's no exit. Once you start trying to prop up your economy by doing this nonsense, there's no exit. You can't ever get back. You just have to give it bigger and bigger and bigger doses until at some point, reality happens.
Yeah, until you kill the patient, right? Or kill the drug addict.
Yeah, or you have to take them off completely, or else the patient dies. And when you do that, the withdrawal is far worse than if you had confronted the profligacy up front.
Yeah. Crazy stuff. Now, just going to politicians, I think our average listener is kind of always looking for that politician who really speaks the truth, who isn't swayed by the lobbyists and everything. Is there anyone out there that we can look to going forward that you know of? I mean, is there anyone who you get behind and say, he speaks the truth, he's got the right angle on the markets?
Well, let me leave aside the last part of your question, but to the first part of your question, there's anyone who speaks the truth? Yes. First numbers 1, 2, and 3 are Ron Paul, and Ron Paul. Ron Paul was the only guy who got this or understood reality. Now, as far as the markets go, I don't know. I don't think he comments on the markets, but his understanding the underlying mechanisms, it's Ron Paul. These other guys, I don't like making. It's funny, as strong as my political beliefs are, I don't like making anyone's job harder for them. I try not to criticize our president too hard. Guy's in a tough spot, don't want to make his job too hard for him. But he just suffers from a bunch of advisors who have a terrible philosophy and worldview. But that extends back through George Bush. That extends, I don't know how many decades that extends back. But basically, maybe since the creation of the Federal Reserve, none of these guys understand reality other than Ron Paul, Rand Paul, and people of that ilk.
Yeah.
All right, guys, just jumping back on here as we come towards the end of the show. I just wanted to go over a couple things going into this coming week. Obviously, we talked about volatility returning, but if you're wondering when the big down move will come, one where you'll see a 10% drop and the NASDAQ start to roll over again, you are really going to look at after July 4th. That's where the bigger move should come based on now. You're still going to get volatility. You're going to get situations where the market looks like it's going to break lower, but I still think they'll keep it afloat through July 4th. So look for choppiness with maybe 3% pullbacks in the market, maybe even 4%, where they bounce the markets back up. But ultimately, that's what we're seeing here, folks. And again, just keep your wits about you. Keep learning. It's been a pleasure. Bid you farewell. Have a great Memorial Day weekend. This is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com, and this is In the Money Stock Market Action on 820 AM News Talk Radio.